Okay, so we are on Unit 2, and we're going to finish off where we started a couple of weeks ago, for those who attended the course. So what the new template should have been sent out to everybody that's on the email list. You can go to my channel, or if you're part of the real estate club, you can reach out to me to get that if you haven't received that yet. But some small additions were, well, not additions, changes were made to this, the three statement model we began with. And that was just to make this a little more dynamic, so that if we want to make changes to anything, that it should flow properly through the whole model. And so what that was, all the forecast data of these expenses here were based on the historical averages. So that's all put in nicely there. So that's, I think a couple of these were not in that format on the past one. So that's been updated. But I think everything else should be pretty much similar. I think I changed some of these numbers just to create a say a more accurate scenario for what I'm trying to achieve here. But everything else in terms of the three statement model that I've gone over should be the same. It goes through the same. Okay, so where we're at now is down here in the DCF model, discounted cash flow model. So some of these you'll see there's already some information in here. And so that's going to be the tax rate that's based off of the three statement model average. The discount rate is down. No, sorry, it should be up here, down here. Okay, so what we have is the weighted average cost of capital, which you hopefully have heard of before, but I'll quickly kind of refresh that if you haven't gone over that a while, if you've never heard of it before. But so if you haven't heard of it before, the weighted average cost of capital takes the weighted average cost of your debt and your equity to kind of find an average discount rate to the firm that can be used for discounting the cash flows back to present value and kind of identifying the enterprise value of the firm. So the debt is relatively easy. Usually you would take a weighted average of their outstanding debt, and you would take whatever their interest payments are, and you'd weight that, and you would kind of get an average cost of their debt. So that's pretty straightforward. And then the weight of debt simply is just the market value of the debt. Okay, and then you add that, well, you divide that by, the market value of debt plus the market value of equity, which market value of equity plus market value of debt will give you the market value of assets. So you're taking the market value of debt divided by the theoretical market value of the market value of assets, and so what you're getting is what percentage of the firm is funded by debt at market value. So again, this is market value, so it's not balance sheet items. Balance sheet items are historical costs, so that's not going to be your market value. In fact, especially the debt should be relatively similar, the balance sheet and market value, but the equity is very, very different. You'll almost always see the market value of equity significantly higher than the book value of equity. So simply the market value of equity is the number of shares outstanding, and usually it's the diluted shares outstanding, and that's multiplied by the current share price, and so that gives you the market cap. And so I have that in here. It's 110,000 for this example, and now I did make these numbers up, so we got $11 a share and 10,000 shares outstanding. This is not any specific firm. We're just using this for the analysis, but it's very easy to find the share price of a firm and the shares outstanding. There's a lot of resources that you can find to figure those numbers out. So you have the market capitalization. So this is market value here. Intrinsic value is what we're going to calculate. So these numbers here aren't quite accurate yet. So market capitalization, we add the debt and we subtract out the cash, and that gives us the enterprise value. That's the kind of the formula for enterprise value. Now, I'd be wondering, why do you minus cash and add debt? So you take the market cap, which is your equity, and then you plus your debt. So then you've got kind of your assets. Well, if we're acquiring a firm, we buy all the equity, all the debt, then we're going to assume the cash that it has. So in a way, whatever cash is on hand is going to be ours, and that can kind of offset some of the costs of the acquisition here. So that's why we take out the cash there, and that gives us our enterprise value. And the equity value is just referencing up above. It would, if you were backing out to get to your market cap, you would take the enterprise value plus cash minus debt, and then you get this number. And then that's what we'll actually do over here. So now the cost of equity here is a little different. It's not as simple as the debt. If it was a stabilized company paying out relatively stable amount of dividends, and you could use it the dividend cost of equity calculation, but usually what we use is the capital asset pricing model. You can look up that online. It's a relatively straightforward formula, but it just takes the beta of whatever company is, and then you multiply that by the equity risk premium. The equity risk premium is the historical market return. So you could use the S&P 500, and then you subtract out the risk-free rate, which would be a treasury rate. And so that gives you your additional risk that you're taking on for investing in an equity, in a market equity, rather than a risk-free rate. So you take that, multiply that by your beta of your company. Your beta is a measure of how your subject firm moves in comparison to the market. So if it's above 1, it moves in a higher magnitude upwards or downwards than the market by, for this, it's 1.14. So the market moves up 1%, then this should move up 1.14%. If it moves down, it should move down 1.14%. If it's less than 1, it means it's less volatile, moves less than the market does. And yeah, so it's a measure of volatility. So the higher this is, the higher our expected return is going to be, and the lower. So we take our beta, multiply that by our cost of equity, risk premium, sorry, and then we add the risk-free rate back into the equation, and that gives us our expected equity return, and then we use whatever the weight is, and then so that gives us our weighted equity. Now, I didn't go over this earlier. With the weighted debt, it's the cost of debt. It's our weight multiplied by a cost, and then we do times that by 1 minus the tax rate, because we get that tax advantage with debt, where we get to write the equity, not the equity, the interest payments are off on our income statements. We pay less tax. So that's what we have there, and then we add all that, the after-tax cost of debt and the cost of equity, and then we get our discount rate. So we've got 8.1 for this specific firm, and so that goes in up there. The perpetual growth rate is like a stabilized growth rate. So the perpetual growth rate, what it does is it takes so this is a 5-year DCF. So what we do is we do whatever our free cash flow is in year 5, we multiply that 1 plus the perpetual growth rate, and then we divide that by the discount rate minus the perpetual growth, and then it gives us a terminal value of the firm. And so what that's capturing is it's kind of capturing an infinite amount of value of future cash flows, and it gives us a kind of a figure of what you would pay for that at that time. And so then that's in year 5. And so then we're going to discount that back to today. And so then we would get our terminal value of the firm. And so then we're going to add that with our present value of our free cash flows, and that gives us the enterprise value. So that's what we're going to be doing here. And so these are our discount factors, and really all this is 1 divided by 1 plus the discount rate to the power of whatever period that is. And that's your present value formula. You can easily look what is the present value formula up. And by getting a discount factor, we're saying what is the value of $1 in one period. And for this example, it's 1 year from now. This is year 2. This is year 3. And so I have them referenced below here because I have these as invisible numbers. If I make this black, you'll see that it says 1, 2, 3, 4, 5. And 5 obviously each period's the same as the year 5. So they're there, and I just don't want them to be visible in my model. But here it just states this is 1 period, this is 1 period, this is 1 period, this is 1 period, etc. Because sometimes you might have, if our entry date isn't, let's say for example this was May 2022, we're not going to have a full period, so we're not going to have a full discount period. So that's the reason why I have these here, just to show that there is a full period there. Okay, so what you're going to do is you're going to multiply your future value by this discount factor, and it's going to give you a present value. So there's different ways you can do this. You don't have to do it that way. You could simply just work it into your formula here, but this makes it, especially as we're learning this, if we are not familiar with this, I want to have that there so you understand what's going on. Okay, so let's begin getting into this valuation here. So let's find, we start with the earnings before interest and tax, okay? Because that's going to be our operating income before any, we don't want to use net income. And I might have explained this in previous classes because we're going to assume a neutral capital structure here. So when we're calculating this, so we don't want any impact of interest because we want to be able to evaluate this and compare this to firms with different capital structures. Because if we use net income, then one company that uses debt and then one company that uses more equity, they're going to have two very different valuations when in fact maybe they're exactly the same. So that's why we're going to use earnings before interest and tax to begin with. So let's start off and go equals our, and now be careful when you're doing these models, you might accidentally reference the historical data, which I've done before. So make sure we're starting here. So earnings before interest and tax. Okay. And then actually we'll go through and then copy it across because that'll be quicker. So then we're going to reference here, then multiply by the tax rate up here, anchor that with F4 because we want to keep that consistent. And then if we do this minus this, gives us our net operating profit after tax. Okay, then that's, so we've already taken, EBIT is already a past depreciation. So depreciation has already been taken out of this. So we're going to add it back because it's a non-cash expense. So let's go find depreciation up here in our income statement. That's right here, and add that back in. And then we're going to have our changes in net working capital. And if you remember, that's our current assets minus our current liabilities. In my models, I do not include cash into the net working capital because it's not an operating asset. So I'm looking at what's going on in the changes in the actual operations in the firm. That's our, accounts receivable, etc., inventory, and our accounts payable. So we have that up. here, and we forecasted that and added that into our support schedule. So our change is going to be here. And then because actually these changes in net working capital and changes in capital expenditures, they're going to reflect what the change in cash is in the firm. That's why we're assuming capital neutral, because we're assuming that could either be funded by debt or equity, or the cash flows of the firm. So capital expenditures, we're going to go, I have that up here. There we are. So capital expenditures, additions, disposals. Okay, here put a negative because it's going to be a negative cash flow for 2022. Okay, so what we're going to do here is we're going to take net operating profit after taxes. We're going to add depreciation plus this because it's negative, and then plus this, and we get that. And let's copy that right across. Awesome. And you'll see the perpetual growth was added in now because I already formatted that. Okay, let's go see what's happening there. So what we're doing is taking our last cash flow, multiplying that 1 plus B175, which is our perpetual growth rate, and then we times that by our multiple. Okay, so the multiple, I just did 1 divided by this minus this. So it's just like, what is that $1 value worth in perpetuity? And so you multiply that by this amount times 1 plus the growth, and then that gives us our perpetual growth there. And I have our sales and our comps in different tabs here, which you'll see. So I've taken, I've made these up as well. But this is what you would do in evaluation. So you take the comps table is taking similar firms in the same industry and taking their price, their share of their stock, their shares outstanding, get their market cap. Net debt is just the debt minus the cash, and so that just gives us it just kind of, when we're doing the enterprise value, remember it's you add cash minus you minus cash plus debt, so it's just doing that in one step, and then you get your enterprise value. So then you're comparing what the enterprise value is to their sales, their EBITDA, or their PE ratio. So these two will yield both enterprise values. P value is based off of an equity value. Okay, so if you're taking the of a PE multiple, then that's going to yield you your equity value, not your enterprise value. So just make sure if you're doing that, using this, that you're not treating this as an enterprise value. And then our precedent transactions, these are actual companies that have sold within a certain period that are in the same industry. We usually use the same industry, and you do the same thing as you kind of do with the comps, and you get it's called a relative valuation. So you can kind of see what your company is worth to your earnings based on transactions that have occurred. This is very commonly used in real estate, like appraisals and valuations. They take sales that, because there's a lot of volume of sales in real estate, so you can take, well, what's the average house price per square foot sold in my market area, and then you multiply that by the square footage of your house, and you get a valuation. And similarly, if it's a rental property, you can just take what its operating income is, divide it by the price that it was sold, and that gives you something called a cap rate. And then you take your property, what your operating income is, and divide it by the average cap rate, and you get a value. So it's kind of a similar deal. And we did that in our real estate models, if you remember. Okay, so we go back to them. We take the average of that just to get a kind of consistent average of what the value could be, because no one method might be correct. So the more options you have, the averages you can gain, the closer to the real value it should be. Okay, so we have our cash flows here, and what we're going to take is the present value of these. So remember I said before, take the future value of these, multiply it by these factors, and take that. Okay, so this has summed that up for you to save some time. This has taken the present value, terminal value, so this should be actually based off of the average there. Okay, so and it's multiplied by a factor there. Okay, then our intrinsic enterprise value is the sum of those two. Okay, so we get an enterprise value, shares outstanding 10,000 minus our debt, and then we get our market value of equity by minusing our debt plus then the cash we have, and then we get a equity value per share of 13.25, which is higher than what our assumption is. Well, not our assumption, what the actual price is. So if you were an analyst, and you were working for, say, a hedge fund, and you're deciding whether to buy this this stock, you would use this, and if this model was accurate, you would make the decision to purchase the stock. Okay, so I'm going to see what's going on here, because it shouldn't be negative. Okay, so what this is saying is if we bought the company at its in entirety, so the enterprise value, and then we're going to get these cash flows in the future. Okay, I see what's happening here. This, and what we're going to receive here is we're going to receive this at the end if we exit out in the 5th year. And so if we do that, if we buy that in all cash, that's what this is assuming, all cash. We're not making any levered assumptions here, but we would get a 12% return, which isn't too bad. So that's good, because 12%, remember, that's our IRR there, IRR, sorry, and our discount rate, so our cost of our weighted average cost of capital was 8%, which is lower. So that means we can generate a higher return than our cost. So that is a good sign for this scenario. Okay, so that's a reasonably easy to understand discounted cash flow model. And if you followed the steps and got these answers here, you'll be able to, if you ever kind of forget a step, you can come back and see, well, what's going on here, which is what I like to do. That's why I love Excel, because you can, as long as you make sure you use references, you don't just hard code anything, as you can always see where you did everything. So it was very common, I'll forget, how did I do something? I'll come back to an old model and I'll look at it and go, oh, okay, I can see that I did net operating profit plus depreciation minus that, and then, okay, oh, that equals that. And then you can remember, you know, if you do that enough, you'll remember these things. So it's great to keep these models in a easy to find place, because you never know when you might need to access these again for your reference. Okay, so we've done that. One other thing I'll go over, and this is already inputted for you because it's based off of our 3-statement model, is this is if we were, you know, say we were working in corporate finance and we're trying to decide, do we need to issue more equity or do we need to issue more debt to fund our operations? We're going to look at our additional capital requirements. So now there's different ways people do this, but this is the kind of way I like to look at it, is you take a cash turnover ratio, which is our revenue divided by our cash on hand. So you get these multiples here. And I also like to use cash to current liabilities, because the main reason you keep cash on hand in a firm is if you suddenly need to pay for a current liability, or you have a funding gap where you don't have any money coming in because you're waiting on accounts receivable. but you need to pay for something. Well, you've got some excess cash on hand to pay for that. So what I'm taking here is our cash divided by our current liabilities, and we're taking kind of an average of that to determine what we need, and so that's what I've done here, and so I've kind of taken the required cash. I've taken what these ratios are and used in our forecast. So what is the revenue on forecast? We did that, and then I'll multiply or divide that by our cash turnover ratio, and we get our required cash. I do the same for this ratio. Then I get an average, and then I take what our actual cash balance is at the beginning. Now it has to be at the beginning because we're going to take our operating cash flow and our investing cash flow, and then that's going to give us kind of what our ending should be. So if you take ending, then you're going to double count some of these. So make sure it's at the beginning. So this is going to be the ending. So for beginning 2022 is going to be the ending 2021. And so it's going to be the same for all of these. And so what we do is after that we take required, and then so we take what we have, and then we minus the required, and we're going to get either if we have a surplus or deficit of cash. And then what we're going to take is we're going to add our cash flow from operations and our cash flow from investing. Investing, that's your capital expenditures, etc. And then at the end, we're going to get either a surplus or deficit. And if we have a deficit, then that means that we're going to have to increase something in our financing section. So we're either going to have to issue more debt, we're going to have to issue more equity to be able to fund our growth or our expenditures. So here in all of these scenarios, we have an excess, so that's good. But you don't want your excess to be too high. You don't want to have too much cash on hand because cash doesn't really earn us much return. You maybe get 2-3% at the most, but that's about it. Where you're seeing here, well, we're able to get 12% returns by our cash flow. So investors might not like a lot of cash on hand because, one, you could either be paying out more dividends, or you could be investing those back into the company to grow and expand. So that I added this in because I think it's something important to identify, but it's not part of our DCF model or anything. So that's that. So we've got some charts here, and I will go over charting in another video recording lecture, but these are relatively easy to do. Let's just do one now, actually, just to see how it's done. So I will do, let's go up to here, go back up to the income statement. Let's look at our revenue by our gross profit. Oops. Okay. Actually, I'm going to go there. Revenue, gross profit. Okay. I'm going to insert a chart, and let's go. First, let's go to recommended charts. So I like this chart here. And so let's go Control X. Get that out of the way. And let's print that down there. Okay, so we've got a nice chart here. You've got to probably edit some things here. The gap width I like to change to about 70. So that already looks better there. I like to get rid of this. Give it a title. So when you want to name these series 2. So series 1, go edit. let's give it a name. That was revenue. And this was gross profit. Okay. And so if we go back down to here, now those are added, that looks better. Let's give this revenue and gross profit. Do that. Change these to change that to accounting, and then let's get 0 decimal places, and that's good. So there's a nice chart there. Sometimes I will make no outline, so it just looks like that. It kind of sits in them into the model nicely, and you can see it kind of matches these ones here. So that's easy to do. Now, something actually I wanted to quickly go over with some other forecasting assumptions. I think I talked about this in a previous class, that you could use different methods. So now if we're going to just assume for a second that this is all historical data, because what I'm going to try to do here probably isn't very good to do for 3 years of historical data. We'd need probably at least 5 years. So I'm going to show you how you can use statistics to forecast future assumptions. So let's make a new tab here. I just like to get rid of grid lines. Move this over here. Let's call that stats. Oop. Let's go back over to the model here. So let's do revenue and gross profit. So Control C, copy that. Now about here, just go Alt ES, and let's go values and then transpose it. See what transpose does. So if you notice before they were going this way, now transpose, switches that transpose and then puts it this way, because I want to graph that. I do want to graph this. I want to do some data analytics, sorry, to this here. So this was revenue. This was gross profit. Actually, I don't want to do gross profit. I wanted to do cost of goods sold. My bad. So let's copy that. And okay, cool. Cost of goods sold. All right, so let's graph this first. So just highlight this and insert. Let's do a scatter plot. Okay. Okay, you can see it's very, very consistent data there. That if I draw a line through this trend line, linear, almost every data point does touch the line. So we've got a very strong relationship here. So let's add another element. Go to trend line again, and then go more trend line options. Then I want to display the equation and the R squared. Okay, so there we can see already the R squared is extremely high. Okay, so if we got an R squared over 0.8, that indicates a strong relationship, and over 9, you've got pretty much obvious relationships. So I could go ahead already and say I'm going to use this y equals this formula here, because our relationship's so strong. So what is that telling you? Well, it's our independent variable here is revenue, okay? And so that's charted on the x-axis. And then our dependent variable is cost of goods sold. Now, if you're like me for a while, I was like, independent, dependent variable, what do you really mean by that? So try to explain this in a very simple manner, is we're saying we're keeping revenue kind of not consistent. We're trying to test to see how does cost of goods sold respond to a change in revenue. So our independent variable is the variable that is changing and influencing the dependent variable. Okay, so the dependent is what we're looking to observe a certain relationship in, or see what occurs when the independent variable changes. So for here, we're saying that when revenue changes or increases or decreases, what happens to our cost of goods sold? And so obviously, you can already, you probably don't even have to do any analysis here and to say that, well, obviously, if we sell more products, our cost of goods sold is going to be higher. Okay, so that's why I'm using this scenario, because it's an easy one to understand. And so before we were using, okay, well, if it was a percentage of cost of revenue was a percentage of the cost of goods sold as a percentage of revenue, and then we use the average. But here we could have, if we had this equation, we can use this to forecast cost of goods sold in the future, just by knowing what the revenue was. So what we have here is our y-intercept. So y-intercept equals 15.799, and our slope is 0.4285. Okay, and this is negative, sorry. So let's say x is what our revenue will be. Let's think, okay, if we have $100,000, what is our cost of goods sold is going to be? So, and then what's y equals? Well, it's going to equal x multiplied by this. Let's put some parentheses around there. And then let's add that. Okay, so it should be around 42,000. Okay, so let's see if that is true on our graph here. Okay, so let's insert a shape. Let's get a line here. And actually, I need to put something on my chart here to make this easier. So let's go to this bottom line here, go to labels, and you want to put tick marks, sorry, go to tick marks, and you're going to want to put it inside. Okay, so now you can see these little lines on here. So I just need that to, because 100,000 here, you could, there's kind of, if I did it here, it's going to give me a lot different value than if I did it here or here. So I just want to see exactly where it's 100,000. And let's insert a shape, this line. So I want to put this line directly there. If you hold shift, it makes sure the line's straight. Okay, so we're hitting right there. Copy that. So Control C, Control V, and you'll get another one of these. I want to put this right on there. Okay, and then make this line straight right there. Okay, so this is where it's heading Y, and you can see it's just a bit above 40,000, and that's probably, it's around 42,000. So that's, that's our formula here is working. Okay, so we could have used this formula here to forecast what our cost of goods sold was using this formula here. Now I'm going to just show you one other way you can do this. As you go to data, and now you might have to add this in, so I'll show you how to do this. So if you go options, add-ins, and you're going to go, you're going to add the analysis toolpack. Okay, and then you're just going to go okay, and then add it in, and then you're going to find that you'll have this data analysis here. So you're going to hit data analysis, and you're going to go to regression. Okay, our y, remember our y is our dependent variable, so that's going to be cost of goods sold, and x is going to be revenue. And actually, let's do, okay, no, sorry. I want the data to show revenue and cost of goods sold, so that I want to go y, and I want to make sure it has cost of goods sold, but I want to hit labels here, because then it's going to tell Excel that the top value there is just a label, not a data point. Confidence level, stick with 95%. and we want to put our output range as about here. Okay, go okay. So we get this here, and you'll see R squared should be, so 998, so it's the same there. So this just gives us some more things to look at. So what you want to look at is our t-stat. We have a very high t-stat. A t-stat is just the coefficient divided by the standard error. The standard error is super low here, and that just measures the kind of the amount of error or amount of space that these residuals lay away from the line. And so it's very low here because you can see that there isn't, most of these plot right along the line. Our p-value is extremely low, and the p-value can be a little bit confusing, but what it's really saying is what is the probability that cost of goods sold does not have a relationship with revenue, and here it's so low. And so what you normally test it against is, remember before we had a 95% confidence level, so we're 95% confident that this does have a relationship. So what is, then we're 5% confident that that's our critical critical value. Sorry, that's what I'm trying to say. So if our p-value is above this 5%, then this model is not really good. We don't have a clear relationship there. But if our p-value is less than this, then we're pretty happy with our model here, and there's a clear relationship, and then that means that we can use these values here to forecast or use in our regression model. So we can use this to say, okay, well, when we have X amount of revenue, we're going to have that, and then we're going to take away what our y-intercept is, and then we're going to get our cost of goods sold. So that's really what you got to look at when doing this. You're going to look at, okay, what's my R squared? That's the first thing I look at. I look at what's my t-stat, and then what's my p-value. And if all of these are showing clear indication to a good data set and a good model, then we're good to use it. This is very useful in financial modeling, and it's very, very easy to implement. You just, Excel does it all for you. You don't even know the math behind this, and I couldn't do this by hand, but you want to know how to interpret it. That's the main point. And so we're going to go into a little bit more of this in some next units. I'll have some, unit 3 is going to be structured, but then after that I might do a couple of lectures on just little pieces you can add to any of your models. What I will do here is I'm going to share another screen. Let's see, I want to just give a quick, okay, let me open it here. I want to give a quick dive into the next unit to see, just to give you guys an intro to what we're going to be going over, because it's pretty cool. Okay, so let me open this up for you. Okay, let me share the screen here. Okay. So what I have here is, this is unit 3, is we're going to be doing portfolio optimization. And so I quickly created this last night just to clean up some of the stuff I've done. And so for the first kind of class, we'll probably do this with 2 stocks. Okay, just to give you a understanding of what's going on. And then I'm going to implement this with, let's say, 10 or 20 stocks, or however really many you want. And you'll start to see why this is very important, and it's a pretty cool thing to design. So what I have here is this is all the data I pulled, and you're going to have all of this. You can see some of this okay, it's all there. So what I have here is, I think I have over 100 stocks to choose from. all here, and I've got historical data. This is all accurately pulled from Capital IQ, which is a financial resource. Now you won't see that because I copied and just pasted it in because I don't assume that you'll have access to Capital IQ. So I just copied and pasted here for you all to see. And you might also see that I've only done this up to the end of last year. And the reason I've done that is because, you know, if you kind of kept up with the markets, they've been very volatile, and, you know, most equities are down reasonably significantly from the year end. So if I was to use the last kind of 6 months data to perform what I want to show you, it probably isn't going to work that well. Now, last year equities did very well, and so this works. So that's why I've done this. So do not ever take anything that I learned. I'm teaching you from here and try to, you know, make some investment decisions based upon this, because this is from quite a while ago now. And so here you're going to have this whole choice of stocks to choose from, all of these. You know, 2 choices to start with here, and it's going to automatically input it into here. And so actually I'll scroll down to the bottom, and we're going to be able to graph the capital asset line like this, and our portfolio, our different portfolio returns here, and there's risk. So you know, if this is going to change, if I change this to, let's say, Snapchat, you see this changes significantly because now there is a lot more volatility in these portfolios, and so this line and there's even in, because Snapchat has negative returns. Also, this is daily returns, so if this looks really low, that's because it's daily returns. So if you see Tesla here, which has 0.26 average daily returns over this certain period. So if I multiply that by 252 is the number of trading days in a year. And then I minus 1, not 14. Wow, that gives us almost a 100% return, compounded, and it's a compounded annual return of Tesla. If you earned this every day, 252 days, this would be your annual return with compounding taken into effect. So 93%, well, it's very high. But if we look back to our data, where is Tesla? Tesla here. So we ended the year at 352. So if I can copy that, and let's go down to the bottom here. Okay, so we ended the year at, okay, so I'm going to do equals that divided by that minus 1. We had a 50% return in the year. So that means our 90% is accurate because this is just a simple return. So before we were compounding that every single day for 250 days. So of course it's going to be much higher. So that's, yeah, it had a very high returns in this year. And if you followed Tesla's stock last year, you probably understand where that's coming from. So this is a pretty cool model to see what's happening here. And so this line here charts the capital asset line, and what it's saying, where this intercepts, this line here is our optimal portfolio right here. And you can actually earn additional returns. And I'll talk about this a lot more by shorting the risk-free asset and investing that into this portfolio. But that's how that charts this line here. And so I'll send this out, and you can just see, it's quite fun to see what happens with different stocks here. You know, this changes significantly. Let's try get, let's get Moderna, and let's do Apple. Okay, so that's just saying, so you see here, it has a max Sharpe ratio. This is saying to do it's saying optimal portfolio is 100% Moderna, because, wow, you can see there its returns are very high compared to, okay, that's American Airlines, not Apple, my bad. let's try to find something that in here. Go up more. Let's do the let's do Tesla and Moderna. See what it says. Okay, this is a nice portfolio here. So it's saying where the maximum Sharpe ratio is, and the maximum Sharpe ratio is where you, for every, it's the optimal optimal portfolio where you get the maximum return for the least amount of risk. So here it's where the highest return and lowest risk is. Not the lowest risk in the whole portfolio, but where you get the optimal amount of return for every unit of risk. So you see this portfolio here. So what's going on here? So Moderna has a lot of volatility. So does Tesla, but Moderna has a lot more. So it's saying you could get a lot more risk by having a portfolio higher in Moderna, but you'll get a bit higher return. Or you can use this optimal range here, and you'll get this kind of return here, and you'll get this unit of risk. So that's what this chart's all the possible. This blue line charts all the possible returns and risk you can get with no shorting, just a simple buy of different weights of these different assets. That's in units of 1%, 2%, 3. It's going up in 1% of different weights, and so that's what that chart's there. And so then this line charts with the risk-free rate with some shorting in there. That's how I get that line. So I hope you will be excited to complete this, and it gets, especially when you get the choice of 10 stocks, this starts to get very, very fun. And this graph here will look very, very well. It'll look like this, but there'll be many. We're going to do it with 10,000 different portfolios, and so we're going to use something called Monte Carlo simulation, and it's going to take a simulation of 10,000 trials, different portfolios. It's going to plot them and give us what a kind of a normal distribution of what we expect the returns to be between. We might do it with, I think we might start with 10 stocks, just because it might be a lot to handle in some computers. And yeah, you'll see how that works, and yeah, we'll go from there. And that'll be unit 3, and then we'll move on to some other cool financial modeling situations. So thank you for listening, and if you have any questions, feel free to ask me, and I'll do my best to answer them. Thank you.